with that, the market is officially open for trade. Joining me now is Greg Lemos-Stein, Chief Corporate Analytical Officer at S&P Global Ratings. Greg, welcome to NYSE Live.
Thanks for having me.
Okay, so Q3 earnings season, we are in full swing. What are your takeaways so far?
Well, overall, we are seeing resilience and mostly positive results despite some of the volatility of recent days. So the earnings look solid, but the positive story seems to be increasingly concentrated in some sectors that are benefiting from AI investment, like the big tech companies. Other sectors, like consumer-facing ones, have been a bit less positive. In terms of credit quality, we're seeing a bottoming out of key ratios that we look at on the back of recent Fed cuts. But again, the improvement's not across the board. So there are winners like the higher rated investment grade companies, the sort of smaller, more indebted companies at the lower end of the credit spectrum are struggling a bit more.
All right, and of course, NVIDIA's earnings will be released Wednesday after market close. What is at stake with those results?
Right. Well, I don't have a crystal ball. We don't really, but our tech analysts are, of course, looking very closely at the results because there's a lot of assumptions about AI growth that create a huge spillover for other companies. So it's always closely watched for the whole AI story. Let's say there obviously will be a remarkable growth, but it's about the trajectory and the ability to maintain the massive growth that we're seeing. We do have some concerns about the massive rush of investment and whether ultimately there may be some overinvestment in some corners of the AI story, but we really haven't seen that yet.
And I know you touched on this, Greg, but how would you describe, can you get a little bit more into the overall earnings momentum this quarter?
Yeah, overall, fairly positive and really remarkably resilient when you think of all that's transpired. Really over the last several years, there really hasn't been any period where the markets have been shut or for new funding, except for maybe April, and we had a weak second quarter. But the market has been pretty solid, and but there are risks when we look ahead. We think about geopolitical risks. We think about U.S. policy uncertainty. Tariffs are not completely off the table by any means, and valuations are quite high. But the signals we're getting are still quite resilient.
All right, and what role are tech companies playing in these results?
Well, a lot, and that's where it really gets interesting. So we look at an aggregate earnings picture of about 1,500 companies that reported as of just a couple of days ago. That's about 2/3 of all the companies we have credit ratings on globally. And overall EBITDA growth, that's a key measure we look at of profitability, is up 5.4%. That's 1,500 companies. You take out just 8 of the gigantic tech companies from that, the overall declines to 3%. So not a bad story, but just very different when you take out just 8 of those 1,500.
All right, and Greg, we've also seen some shifts in tech growth and spending. What is your perspective on that trend?
Well, it's huge, and again, it spills over into a lot of other sectors because one company's capex can be several companies' revenues and cash flow. So far, this quarter, the capex story even more skewed than what I just described with profitability. So trailing 12-month capex is 54% for those 8 giant tech companies year over year, compared to less than 8% if you look at all the other companies outside those 8. Again, that's not a dismal picture by any means, but it's very different than the overall, which is about 14 or 15%. Looking just quickly longer term, it looks like global AI spending is up to about close to $500 billion this year, and there's some views that it may even double to $1 trillion by the end of the decade. But that's an interesting story about how we get the power and the cooling necessary for these massive data centers and other AI investments, and including chips.
All right, and in our last minute together, the longest government shutdown in U.S. history just ended. It lasted 43 days. From your vantage point, what impact, if any, did it have on the markets?
Well, clearly there were some bouts of volatility, and it doesn't help matters with the economy. But really, from our perspective as credit analysts, when we look at the credit market, it really was not affected at all. There was still lots of availability for new funding and new debt, new bonds and loans. Again, we think about the risks of that growing going forward. But for now, it's been a what me worry type of credit market situation.
All right. Thank you, Greg Lemos-Stein, Chief Corporate Analytical Officer at S&P Global Ratings.
Thank you for having me.